This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Really, sometimes I have no idea where my guests are going to come from. You might be thinking that there's a master plan. I've got it all figured out. One guest builds on another and all that kind of fun stuff. Now, that actually does happen sometimes, for sure. When you're trying to land your second Nobel Prize winner, it helps to have the first. And if you have 4 of them, it helps to land number 5 on the Nobel Prize front. No doubt about it. You can see that chain. Maybe I'm crazy. Maybe that's not how it really works. It's how it's worked for me. I think it also helps on the trading front, my specialty. You get a lot of really cool names involved in the show. Other people want to come on. Then there's sometimes just the completely random situation. One of my favorites on the show, Jerry Parker of Chesapeake Capital, of the Turtle Trader fame. Recently, Jerry said to me, "Hey, Mike, you should really talk to this guy I know. Trend following trader, really bright, some interesting insights." Jerry was spot on. My guest today is Josh Hawes. I hope you enjoy this eye-opening conversation about trend following, the financial industry, and all kinds of other stuff with Josh Hawes. What I want to do today with you is I want to kind of discuss some big picture about the investment scene out there, kind of the mutual fund space, and perhaps some interesting insights that you might have. And I shall say that the mutual friend that connected us told me that you might have some insights about Goldman Sachs that could be fun. I don't know if this is something you're willing to talk about or not, because apparently if you talk about Goldman Sachs, they send a Ted Cruz, this new Ted Cruz serial killer thing comes down and kills you. The Zodiac killer will come down and kill you if you talk about Goldman Sachs. But anyways, I want to open it up to, if you do want to mention something, I'd love to hear it, because he just kind of hinted to me. But big picture, what I really want to talk about at the very beginning of this conversation is the mutual fund space, the investment space, just the basic landscape, because, I don't pay that close attention to it. Look, we've had this huge run since '08. Frankly, no one's had to do anything. I mean, they just take advantage of the Fed goosing the rates down, and everyone's long only. I mean, there's no strategy here. Why don't you give me a big picture view and let's start to unpack some of this mutual fund, hedge fund space, because there's 8,000 plus mutual funds. I mean, the confusion that people might feel today is, it's probably only getting worse in the last 8 years. What is your first thought when someone starts to talk about the mutual fund industry?
Yeah, it's actually interesting, because where my career kind of started was really kind of there. To be quite honest, I have no idea if I'm even allowed to mention the dark side. It's kind of the name that if you talk with market makers on the floor and somebody kind of comes in and swoops an order and screws them over, you just always hear them be like, it's dark side. And so I was very thankful. A good family friend of ours was co-partner at Goldman, and he ran a $30 billion mutual fund, and I kind of got to have an unofficial internship with them. And that was kind of my first foray really into Wall Street. I'd always wanted to be like this guy. I'd looked up to him. I respected him so much, and I finally, got in, essentially.
An unofficial internship with Goldman Sachs, having bird's eye view into a $30 billion mutual fund?
Yeah. I got to be there with the asset management team and be under, the two head guys, and really just kind of, it would be, here's 8 books, read them this week. So my first entrance into the world of investing was the mutual fund side, and it was the fundamental side. It was very eye opening. My whole goal throughout
Hold on, hold. Tell us, eye-opening. I want to know some of the sausage making that goes on with the vampire squid operation. I mean, I want to know, are you allowed to say anything? Tell me something. Tell the audience something where they kind of go, wow, that's really, we could turn on Ted Cruz again. He's on TV all the time, but, tell me something more.
Yeah. I will say this. I absolutely learned my work ethic from those guys, from the standpoint of I never met guys that worked harder. And I really have. I've had a chance to meet a lot of different firms, now do consulting and now running a fund and just all that kind of jazz. And I really learned the work ethic. And it was in a different way though. These guys, they would read more than you could just ever imagine. I mean, 4:30 in the morning and the head guy that I'm under is reading these earning analysis reports. He's reading what these analysts are bringing in. Love them or hate them, these guys have a work ethic that is pretty astounding. And yet at the same time, there would be an Xbox and a PlayStation in the office because they're trying to decide which one's going to be better for which company over the long run. And so, you'd see this dichotomy where, you have these guys working hard. You have all these expensive analysts with these, expensive suits coming in. And
what are they working hard to do? I've looked through some of your work on your website. I mean, you nail the mutual fund industry. Just nail it line by line by line, multiple pages, details. So were these guys the good guys that were so much better than all the other mutual funds? Because, a lot of these guys are just long only, right?
Yeah, and that was kind of my, that was kind of the first foray into the space, was that as I'm there, I've always been a math guy and kind of this math nerd. Never the smartest guy, but I just I loved it. And I was kind of like the baseball career. I was going to be that guy that wanted to work harder than anybody. And so, I may not be a PhD, but math's always been a joy for me. And I start looking at the performance of the fund. And this is around 2002 to 2003. And I'm just kind of looking at it and I'm going, where the hell is the return? And it was just one of those things where I'm like, these guys, they adamantly believe in what they're doing. They really take the responsibility of fiduciary duty to their clients very, very seriously. They're always trying to get an edge. And yet, I'm reading about these other guys that get not just return, but big return. And so that was, kind of how I started to transition out.
I need some more grist here. There was more fat on the bacon than you're giving up. I gotta try and wring it from you from 8,000 miles away. You are working for one of the most successful, or you're working with, however the structure was. You have insights into how one of the most successful firms operates a mutual fund. You've already said that these are some very smart, hardworking people. Is it just that they are in a business? They're in a structure, the mutual fund, where no matter how hardworking and no matter how bright you might be, at the end of the day, the only people that make anything out of it are the managers. How do the clients win when the vast majority of mutual funds do not beat the market?
Yeah, and I think and that really comes back to what's the definition of beating. Everybody seems to have a different definition of that. Because anytime you read the marketing material, they were always beating. It was always, well, here's the index that we compare ourselves to, and we beat it. And this was, 2003, and so I'm sitting there going, yeah, but you're losing like a massive amount of money. How is this the definition of beating? Well, we're beating the index. And that was just, it was where I started to diverge, where it was...
Your aha moment?
Yeah, just in terms of saying, okay, well, you guys do... have this access to information in these CEOs. I'll never forget, I got to, most normal people don't get to be on a call with the CEO of Pepsi. And I got to be on a call with the CEO of Pepsi, and you're sitting there going, and I'm very young at the time. And so you're sitting there going, how do you make a mistake? How is it that you can lose money on a company if you're talking to the CEO? If me as a regular person walked outside this office, I can't talk to the CEO of Pepsi. But because I sit in this room with these guys who are under this name that is so feared in Wall Street, they can call him up and he's going to answer their call, especially when you run that much money and you own 5% of the company as a whole. And yet that was where life kind of, especially from a mathematical perspective, really kind of shined in on, man, stocks really can be pseudo-random. You can have this amazing information, still not make necessarily money from it. We talk about this all the time with regards to, even if you knew what the Fed was going to announce the next day, can you still, predict? Could you still make money off of it? And we've actually done tests on this. And the truth is that you actually couldn't, based on a singular day's moment. And that's because even Fed announcements and how the market reacts to them, A, they're volatile, and B, they're essentially pseudo-random. Now, over time, we get to see, everybody knows that, the Fed has injected money, brought rates down to zero, and so stocks have ripped and rolled to the upside. But the actual Fed announcement day, you could have inside information and still not make money. And that was just kind of that correlation with, holy crap, these guys have information that nobody else does, and yet the game is still that hard.
At this moment, though, do you start to, as you're having this aha moment yourself, is there a point where you start to share, where you start to have, express doubt or share other thoughts with these, as you've said, very bright, hardworking people to get their feedback about what you're feeling? Or is there just a wall and it's like, look, we're making a lot of money here. And if you don't see the writing on the wall, then you need to leave. What's happening?
Yeah, what's funny is, even to this day, so the gentleman that was co-partner at Goldman, who I was under, he's absolutely been a mentor and a good friend. And we always kind of butt heads, but in a good way, in this loving way, because he's always like, whatever, you're crazy, you do what you do, and I'm going to go do what I do. And really, you meet somebody who, it's really no different than talking with some of these longtime trend followers. They absolutely believe in what they do. They'll ardently defend it. And in some cases, they can make a good point, and, they're going to defend it. Now, I will say that being, in Tampa and surrounded by, other firms that are, specialized essentially in mutual funds, definitely met a lot of mutual fund managers that were not as bright as those guys and couldn't defend their position.
Why do they take their positions? I mean, is it literally just keeping up with the Joneses?
I think that it is. And that's actually been something, it's kind of like having a conversation with a Democrat, on certain things, and you can get them to this point where they'll agree with you 90% of the way. And then once it comes down to actually like making the real choice of complete 100% agreement, even though you can tell on the inside the wheels are running, they'll back off at the very last second. And I think at the end of the day, it's, this is what I was brought up in. This is the system that I was brought up in.
I make a lot of money in this system.
Yeah. Exactly. I make a lot of money by agreeing with the system. I mean, there's been times where, I've talked to some of these mutual fund friends, and, their position was, well, I can't do that. I can't be that far from the index, or, I can't do that because my clients, that's not what my clients were sold on. And so, you kind of, ironically, coming full circle now and talking with a few of these now trend following hedge fund guys. And, what's interesting is that even they can fall prey to that in different ways. The big thing in the last few years has been this concept of vol targeting, right? You can talk with some of these guys. You can say, well, an optimal system doesn't necessarily need to vol target. Yeah, but our clients want to see their equity curve. And, in my background, I'm going, I've kind of had this conversation before already.
Smooth equity curve equals, okay, yes, we can ensure that the fees keep coming in, but a smooth equity curve, we all know eventually what smooth equity curves end up looking like.
Exactly. And so, you get it. You start to understand that there's optimal in this life, and there's what optimal looks like, and then there's what a client wants. And there's, okay, we know what optimal is, but we can kind of cater to that. And, I can get some of my mutual fund buddies to freely admit, like, hell yeah, man, we don't want to be invested all the time. Well, then why are you? Well, we have to be. If I don't, Goldman gets pissed at me. And you're like, what? Like, you could look like a genius if it's 2008 and you're out of the market because even by, let's say that your fundamental metrics are even right. So your fundamental metrics, you're saying to get out and you got to deploy your capital. Yeah, man, I can't sit on all that cash. And you're just going, holy crap.
You hinted at something earlier, which I want to follow up on, really key to the point you're making right there. If those particular managers that you're talking about, these guys running these funds, and they know, okay, God, being out of the market would be great at some point in time, but they're not really penalized if they take a 50% drawdown because everyone else took a 50% drawdown. That's the insidious part about this.
Absolutely. What's actually interesting is that when you listen to the both of us talk, me and my one buddy, there's actually a very, close similarity when you listen to the vernacular. From the perspective of, well, when the market goes down, I don't lose as much. It's the same kind of talk that we can essentially have with our clients. Well, when markets go down, we're long short stock. And so, there's a potential for us to even go up big, but also most of the time when the market goes down, we're not going to go down as much. And it's the same kind of talk that he has with his clients. And yes, over time, absolutely, he's been in his world a rock star. He's outperformed the market, and when the market goes down, he doesn't go down as much. But you still have to go back to that fundamental metric of, are you really going to take this long only bet? Are you going to take this Buffett-esque style bet? Are you going to say that, never bet against America and, leverage up your house and mortgage it off and dump it all in stocks because it's the best thing ever? And there's just a massive error, in my opinion, mathematically in that thinking. That's the intriguing part is, you understand why the client gets confused. I think that's the other.
The client is purposefully confused. It's done on purpose.
I was having a talk with a famous fund manager buddy of mine, and we were talking about indexes. And I said, golly day, isn't the concept of an index Wall Street's absolute best marketing mechanism that they've ever created? And he said, yeah, absolutely. It's just, if you think about it, it's this whole back adjusted somebody else's system that everybody in the world compares you to. And it's not even optimal. But if you underperform this non-optimal system, you're screwed in the eyes of the client. Wall Street says, just pile all your money in. Just be a passive investor now. You even got Buffett. Be a passive investor. Don't do what I do. Nobody can do what I do. You either invest with me or you put it in an index.
At least Buffett and Munger, though, will tell people, we expect to have 50% drawdowns.
Yeah.
I mean, they tell people that, hey, it might look good for a stretch, but we're going to take hits. You guys nail the mutual fund industry really, really hard. You nail it about fees, taxes, no diversification, changing managers. I mean, all these dirty little secrets. I guess they're not that secret, but they are dirty. All these dirty little secrets, you guys are just smacking them upside the head and downside the head. But the bigger issue is who pays attention when there's a bull market for 6, 7, 8 years?
That's right. And here's kind of the interesting thing, though, is that, being surrounded by mutual funds like we have, it's actually very intriguing because, a lot of CTAs, a lot of hedge fund managers, a lot of, trend followers in unique ways, they'll look at the mutual fund industry and they go, God, I hate you guys. It's just so easy just to be a closet indexer. And yet, what we're seeing in kind of the hedge fund space, where you've had this massive consolidation of assets, has also really been occurring in the mutual fund space. I mean, there's some big name mutual fund managers that have run billions of dollars, and it's very tough for them to be raising assets because other larger mutual funds have been basically just gobbling up those assets, and passive index investing has really taken over. It's very intriguing to see on, what we would call the dark side, the other side of the coin. They're actually kind of struggling with the same thing that's going on. And, who knows, maybe it's a byproduct of getting close to negative rate policy environment. But there definitely was. We ended up writing that paper from the standpoint of, I really got sick of this same conversation that kept occurring. And the conversation with potential clients was, you guys are really expensive. And you go, whoa, wait a minute. Describe that to me one more time. Well, you guys charge either 1 in 10 or 0 in 20. And you look at it and you say, okay, well, what do you think is expensive there? oh, well, 20% of the profits that I make, isn't that a little hefty? And you kind of have to back them out into it. You say, you know what? It's the way you've been trained to think. It's your view. And yes, 20 sounds like a really big number compared to you pull the prospectus of a mutual fund and all you see is, 1.5 or 1.
All their fees are embedded.
That's right. And so you start looking at front end fees, back end fees, embedded fees. You really just kind of want to answer the question of, you might think that my 20% is expensive, but even in a good year, I may charge you 2% more than what you would have gotten charged in a regular fund. And that's assuming that we're not including all of these back end fees and everything else, which can get humongous. And that's just kind of in my opinion, the raping and pillaging of the retail investor. We always ask this initial question to potential clients. We say, what's the purpose of the stock market? And you'll always get these questions of, well, it's, for raising capital and this, that, and the other. And you go, yeah, those are all good answers. But ultimately, the purpose of the stock market is to facilitate the seamless transfer of risk between two parties. No more, no less. Which basically essentially means, in a politically correct way, Wall Street's job is to get paid. To be the middleman and get paid. And so, so these people, they don't read an actual document and find out, oh man, there's a 4.5% back end fee if I get out of this thing early. And you're going, you call me expensive? The market will be guaranteed to have a 50% drawdown. I'm telling you the worst that you'll have is 20, but you'll make a MAR ratio of at least 12 to 15. So I'm 400% better than the market over the long run. And you're telling me that my fee of every once in a while being 2%, greater is really, that drastic. Oh, well, I guess I didn't really think about it from that perspective. And you're going, golly day, this really was like the best marketing gimmick ever created by Wall Street.
Okay, I'm going to take you back in time, and then I want to bring you up to something current in kind of the basic, what I would call, and you call, the idea. All trading systems start with an idea. Before I get to that, though, I kind of took you off on a tangent. I want to get back to that moment in time, though, where you started to pivot away from this vampire squid association, and that you started to pivot towards what ultimately would become a trend following career. What was the trigger? What was the pivot? What were the experiences? I'm sure there were some books involved and all that kind of stuff, but what were the experiences that led you to start to go down the path of or give me an aha moment? What was the first thing you saw? How did it start? Everyone has to find a trend following start somewhere.
Exactly. Well, and the irony is that it started at my time, at the mutual fund. Like I said, I learned this work ethic from the guy that I was under, and then I just had so much tremendous respect for him. And he would give me all these books to read. And one of the books he actually gave me to read was Reminiscence of a Stock Operator. It was so funny because I'm reading Graham, I'm reading Buffett, I'm reading Lynch, I'm reading all these guys. I'm actually creating algos that are ranking stocks based upon these metrics that these guys are using at this fund. And then I'm reading about Jesse Livermore. And I start to kind of dive into this road, and I actually end up getting your book on trend following. This book,
I was not paid. I got no compensation. Right. I did not know you were going to say that.
Right.
It's true.
So I get get your book and I read this thing, and I start to do my own research. It's just kind of one of those things where I'm a nerd, and so I say, okay, I'm going to reach out and I want to find out, about these guys. And then, ironically, I'm not going to say that I'm an old guy, but I'm also not a young guy. This is the age where, email addresses were still, you weren't getting spammed a lot. So I would reach out, I would guess some of these really famous fund managers' email addresses, and I'd send them emails. Sure enough, I guessed some of them right. And I started asking some of these guys questions. Some would never reply, some would. I actually ended up sending you an email, and you had told me about a conference you were going to, and ended up going to the same conference, and Jerry Parker was there, and ended up meeting him. Ironically, to this day, he doesn't ever remember meeting me. Now that we see each other in Tampa, just started to really kind of meet a lot of different guys in the space, and my whole thing was, it first was just this idea of who's actually making money. And the irony was is that I never really fell for the mutual fund thing where it was like, well, we haven't gone down as much. My whole thing was, whoa. If something's going down and I can short a stock, we should be making money from this. So my whole goal was, who are these guys that are making money year after year? And it was just, going down that road, and that kind of really was the spark of it. I was very lucky. I mean,
no. Hold on. Let's dial that one back. You had to go. you had to guess these email addresses. You had to do something. Most people sit on their ass and don't do anything. Come on now. Let's don't be too humble.
I mean, I will say yes. I mean, one of my business mentors, he always challenged me. He's one of our investors to this day, and he's always been very, very gracious through it all. But one of the things that he really challenged me with was, he said, this concept of 10,000 hours. And he always believed in me. He always said, "You're the smartest kid that I know," all that kind of jazz. But he said, you got to get to the point where you're a master. He said, you have to get to 10,000 hours. And he said, it's your choice. You can either get 10,000 hours in 10 years, or you can do what I did and get 10,000 hours in 3 years. And I really took that to heart. I mean, I will say the one thing that probably my family, my friends, my wife still don't kind of really understand about me is that, I don't lie whenever I tell people that I'm up till 1 o'clock in the morning, 2 o'clock in the morning, doing tests, reading as much as I can. And really just, that was kind of my goal at the time, was I wanted to understand it in its complete form and really kind of master it in the shortest amount of time as possible. And so I kind of took a very democratic, non-biased approach to it, where I said, and this probably comes back to the experience at Goldman of being open to listening to anybody. I will say that those guys where you could be an analyst and walk in the door and they take the time to listen to you. And that's actually kind of rare, at least nowadays, from what I hear. And so I did the same thing. It was, hey, and I kind of did the same thing as you, where I have this huge file on trend following, and it's just all these different guys that kind of ascribe to trend following and have this track record. And I would literally find every article, every speech, every video, and I just kind of compiled this massive file of all these different guys. Guys like Jerry Parker and David Harding and Ed Sequoia. Ed, like one of those guys where he actually kind of answered some of my emails, and I was always very grateful for that. And, a guy like Jerry Parker who, really kind of took the turtle process to heart and actually was disciplined and systematic in his approach. It's been interesting. I've had a chance to meet 3 different turtles now. It's funny how, even for those guys who kind of were supposed to have learned the lesson, some of them have actually been kind of discretionary. And it's the reason why performance suffered, or they ended up getting out of the game and going down a different road. And, and then you got Jerry, who, I love when he talks about sample size. It's so true. But he's been systematic in his approach. He hasn't changed on that.
To add on that, some of the turtles are brilliant, have had great careers. Jerry's the top of the heap. Some of the turtles that I've met are flat out balls to the wall crazy.
Yeah, and it's kind of interesting because it's such a testament to really this concept of what is investing and what is optimal. And so I was very blessed with, there's a ton of information out there, and it just seemed like I was able to go down and read the right stuff and meet the right people and kind of really go down the right road. The amazing part is still having to deconstruct all of it. Still questioning it every day. Still, my partner today, he gets so frustrated with me because we've tested this stuff, literally a decade ago. We continue to do new research, and I'll still question on, wait a minute, are we sure that this right here is optimal? And, just kind of going through all of that.
Let me go big picture for you a second here. I want to let you, as we were talking about the mutual fund space, we're talking about managers that are making big fees for long-only strategies. There's not a lot of brain power that goes into a long-only strategy, or just basically a closet index. There's not a lot going on there, but it's very rewarding for those particular managers and those particular firms. But I want you to go ahead and play with me for a second. So let's imagine, and I want to kind of quote from something that you guys wrote here that your firm put together. Every trading system starts with an idea. The idea is a concept that describes some aspect of the way a particular market or all markets work. So if we were to look at the last, let's say, since the March '09 lows, and we're to look back over that, over half decade period now, and there's so many people that are just feeling giddy with long only gains, and they say, well, what have you bought here at the bottom of March, March of '09, and look at today, and they kind of like just wave their arms, and they like this is somehow or another proving something. But I want you to go back to what you guys wrote about an idea. Explain to the audience. Now, put your engineer hat on, your trading engineer hat on. Explain to the audience about your idea breakdown of looking at, since the March of '09 lows, how you would break down your analysis of that.
Okay, yeah, absolutely. I think that even taking that moment of the March 9 lows until now, I think that that's a fractal moment in time of, these papers that, hey, stocks have been good if you go all the way back to 1835. And it's like, as long as you can just endure this, this drawdown, and stocks end up really being good in the long run. Interesting book, right? And so, for us, it's really kind of, like you'd said, deconstructing what's the fundamental idea in that statement. Well, it's basically what somebody's telling me in those words, and what they're really trying to get at is, well, I should just invest in an index, throw it in there, close my eyes, and hope that the day that I retire, everything's okay. It's really kind of what they get at. It's that easy, right? And we kind of say, well, we'll take it to, what they like to call second and third level thinking. It's really asking yourself the key question of, well, why does the market, A, owe you anything? And B, if something goes down, does that not mean that it can go down for a longer term period of time? And it's like, well, and you see this, especially in the CTA community, don't ever short bonds. You get these guys that will create these, unique one-way rules to a market, and you're going, no, that's not a system at all. You can't say only go long bonds, depending on the market that you're looking at. You can't say, only go long the market because for 200 years it's only gone up. And luckily you get these guys that are obviously smarter, and, they say you got to take out the logarithmic scale, and you got to look at monthly return distribution on the market, and you can see that things, are more volatile than possible. But it really comes back to that idea of really getting down to the idea of what somebody's trying to say. And, hey, it's the bottom of 2009. If you had picked it, you would have killed it. And you're going, yeah, absolutely. But change the day you started now. This is something that you see even in the accomplished, hedge fund, CTA world as well, where these guys will do a test and they go, oh man, it's really good. And you're going, no, change your start date though. And you start to see, oh man, it's not exactly as good as we thought. And that's kind of that, it's, we would call it hindsight bias, right? It's saying, oh, if I'd only bought in 2009, and there's so many things within, especially the English language is so limited, where there's so many things in one singular sentence that you can look to and say, man, you are making these really broad general statements now. Like with, pick the bottom of 2009, and things only ever go up. There's just a real danger in that. I've studied all of Buffett's letters. I like the guy. I know he's been in the news, but one of the things I will fundamentally disagree with him is his concept of never bet against America. I am just as patriotic as the next guy, and I absolutely love this country and will defend it. But at that same standpoint, you can't be a student of history and say that, I'm only ever going to buy America long. It's not prudent, and it's not taking your fiduciary responsibility serious to really kind of do that. Yeah, it's been great for Buffett because he created a company around it, but it doesn't necessarily mean that he's created an optimal investment strategy, in our opinion. I know that a lot of people are going to disagree with that, but that's where it comes down to then what's the statement of optimal? As you know, in the world you deal with the person who says pick 2009, all they care about is return. It's, oh man, just get me what will give me 100% return a year, and I can retire in 3 years, kind of thing.
Let me take you to Buffett again for a second. So you bring up Buffett. He just finished his shareholder meeting, I believe, or it's going on now, something like that. So all these thousands and thousands of people migrate to Omaha. eat a steak at a bad steakhouse and go to Dairy Queen. And then they all, then they all go ahead and they sit there and they listen to these two guys that are, I say it too, they're both brilliant, very successful, have made absolute fortunes. But how, when you look at these two outliers sitting there on that stage, pontificating, how does their wisdom translate? I mean, if we start to break it down, and I want you to take this further, how does one go and become the next Buffett? I mean, you were able to look at the Jerry Parkers of the world, the Ed Secotas of the world, and say, you know what? I can get in here. There's some room for me. I can do this. I can emulate this. I want to know how the thousands and thousands of people that go to Omaha are able to replicate Buffett. They're not. I mean, he's a sophisticated fund. I mean, there's all kinds of option selling strategies. There's, insurance businesses that spin off cash to protect their downside. I mean, it's a complicated thing those guys got going. Speak to that. Speak to those people. Give them some education.
Absolutely. I think 2008 was one of your best examples of it. The money, the dividend, the special dividend treatment that he got for buying Goldman Sachs was the regular average Joe could have never gotten that. Vanguard could have come to Goldman and said, we'll give you the money. Would have never gotten that. That in and of itself is such a clear, and it was on CNBC, so it's not like it's a secret. It was on Bloomberg. Everybody talked about it. Hell, they found him in his airplane when he was, in his private jet flying. Whenever, the time for the, essentially the option to come due was, and Goldman was like, yeah, we don't want to pay you that, that 10% dividend essentially anymore. He was trying to not be found kind of thing. And that's just kind of testament to the types of deals that Buffett can get. But I will say this, and this does kind of translate to also the Sequoias and the Parkers of the world. There's a lot of guys that even run mutual funds that try to be Buffett-esque. If you do, even on a simple system, let's say that we take a turtle type system, you have to run a Monte Carlo simulation. And you get to see that there's a variability in the distribution of return. Some of these guys are going to be on the lower end. Some of these guys are going to be on the upper end. Most are going to be around the middle. And that's kind of understandable. And Buffett's kind of that way where there's a ton of guys that have kind of tried to do what he's done. If we look at it from a very systematic standpoint, some of them have failed. And I think that's kind of a key component of it all, where you're looking at it and you're saying, whoa, some people have tried to do this guy's strategy and they failed. Is he an outlier or is he a genius? I think that he's extremely smart. I think that he's leveraged the actual business component of what he does. People like this whole whale watching type stuff, and you're going, you don't understand. When he buys Procter & Gamble, it's not the same way that you're buying Procter & Gamble. But I will say, in the takeaway of Buffett, there was a great paper that was done on it. He is very systematic in his investing style. And I think that comes back to how it applies to everybody, and something that we've been very kind of, like I said, democratic in, we're just giving no bias. And you see that, I mean, I still have this talk with my partner where it's, high in the sky pie theory type stuff, but it's saying, does the market at the end of the day really just honor a disciplined, systematic approach over anything? Sure, there's concepts of momentum which exist. Sure, there's concepts of, trend and, money's where the X is, all that stuff. It does exist and it is optimal. But, did Buffett make his money because, they've done papers and figured out the guy was literally, they've said that he was systematic to the point of being a computer. And I think that is the takeaway for the common man. You're never going to get Goldman Sachs knocking on your door saying, we'll give you 10%, but you can be systematic like Buffett. And so that then leads you down the road of, well, how can I be systematic? What is the approach? And some people will say, well, I believe in fundamentals. Okay, that's fine. We've done the research. We think that, stocks that obviously are healthy. Yes, in a very long time span, they're basically going to make it, but that doesn't mean that it's now optimal. It's the definition of optimal. And you really kind of have to, if you go down far enough of the road, even ask the question of the 4 whys, that famous business concept, and you start getting to this point of, hey, it's a little bit harder than I thought, a little bit more in depth than I thought. There's a little bit more elbow work and grease that I have to do. But all of that is leading to a profitable long-term system like a Buffett style return, like a David Harding or a Jerry Parker style return, because it's systematic in its nature. And I think that's that humongous takeaway.
It just kind of hit me, the connection between David Harding and Warren Buffett. Do you know it?
They both follow a system to the T.
Well, no, the connection is Goldman Sachs. Goldman Sachs owns 10% of Winton. Buffett owns Goldman Sachs. There you go. We can now call Buffett a trend follower. That's 100% true. Hey, okay, I want to go into some specific areas with you that I really like about how you describe some things about your business and your trend following approach. I really think it's very astute to say that you've got a guarantee. You give a guarantee about many, many aspects of your trading approach to your clients. One of the guarantees is very simple, and I would love for you to expand on it, teach a little, but you guarantee to always follow your stops.
Hell yeah. That is something that, it's, before we get into that, I will say one of the reasons why we give the guarantees is because, I hate not being able to, like a regular business, give that guarantee. In our field with the SEC, it's illegal to do that. And of course you can never guarantee return. You get that aspect of it, but it's being able to look at a client in the eye, shake their damn hand and say, I'm going to do what you paid me to do, what you are paying me to do. And for us, it's being a trend capture, and it's following a system. And part of following that system is always following your stops. Now that can look and act in different ways, but how your system and how your strategy defines an exit point, you got to be able to look your client in the eye and tell them that you're going to follow that. And I think that it separates us from a lot of the fundamental guys, just from the standpoint of they don't even have a stop. They'll continue to layer in. There was a lot of guys who got caught last year in the value trap of energy, right? They started layering in at the first 10% drop, and they were screwed 50% later.
Losers average losers, right?
Exactly. And it really, even mathematically, it's one of those things where you go, hey, is this concept true? And sure enough. But even from, like we talked about before, you obviously more than anybody has had a chance to meet a lot of these different kind of famous guys, and some of them, it's tough to not look at them and go, man, if you had just followed your system, you wouldn't have run into the trouble that you had. And I see that. I see that a lot. I see that with a lot of people that I've had a chance to come across and meet. It's just this concept of it's okay to break your rules. And you're going, no, it's not okay to break your rules. It's fine to have, multiple rules that have been, tested, and each one of them give edge, and it allows you to use, but don't ever break them. Don't ever, and it just comes back to, what is profitable trading? At the end of the day, our view is that it's this, whether you're fundamental or whether you're technical or whether you're a trend follower or whatever the hell you may be, it's creating that positive kurtosis skew. And the only way to do that is by following your stops. It's the only way to keep losers small and let winners run. And, everybody wants something that sounds a lot sexier than that. They want to talk about vol targeting. They want to talk about all this kind of stuff. And you're going, yeah, but at the end of the day, we're all trying to create the same curve. Well, you should be trying to create the same curve because it's the only way to lead to profitability. But, so you gotta follow those stops. Otherwise I've seen too many people. I'm sure that you've gotten these emails before. Hey, I used to have $1 million. Now it's 50,000. What do I do? And you're going, Jesus, like I still feel for you, but wow, there's no amount of return that's going to fix what you fundamentally have as a flaw.
But I do really like, and you do it on many, many aspects. We're not going to go into them all right now, but I like the idea of guaranteeing that you're not going to exceed your max risk, guaranteeing that you're going to, follow your process and not just focus on an outcome. Slightly different area, but in the same headspace. I love the way you just described this very simply. You say there's 4 ways to make money: when prices move, when prices don't move, arbitrage, and high frequency trading. There's really, of those 4 things, the average guy really doesn't have the ability to execute all four of those equally. I mean, there's a certain exclusivity to those particular styles of making money.
Absolutely. That's one of those things that is a great differentiator whenever you get in front of a client on, hey, if you don't fundamentally believe this about markets, then you're not going to, agree with us on anything, and we don't want to waste your time, even though we wouldn't be a waste of your money. And it really is true too. Look, arbitrage, does it exist in a very minimal form these days? The problem is the economic cost to do it is too large. It really is, the satellite connections between Chicago and New York kind of thing. Whenever you have a disparity between futures and cash indexes, that's the arbitrage that exists today. It's sad when you go online and you see like, oh, this is a binary trading arbitrage system, and you're going, bullshit. Like, you just feel bad for all the retail people that, oh yeah, I got this arbitrage system. You're going, no, you don't. And I think that a guy like Cliff Asness does a good job in some of his interviews on talking about what true arbitrage is, compared to kind of the loose vernacular that it's used today. The other is market making, and that, like you had said, is, essentially, high frequency trading now today. And that's just, basically bid and ask spread. Nothing necessarily too complicated from that. It's really the other two. And it's kind of funny because we get, one of them, we actually get a very unique question most of the time that we really don't agree with even some of the trend followers in this case. And that is, you can either make money when markets move or when they don't move. When they don't move, a lot of people will tell us, oh, you mean like counter trends? No, we actually don't believe in counter trends. And they go, what are you talking about? And we say, well, think about it. If markets are fractal, one person's point in time for a counter trend is another person's point in time for just a shorter term trend. And they're like, whoa. And it's like, well, take out the time component and quotient of markets, and you'll really find that there's not really such thing as counter trend trading. And I know that, a lot of people will, my system works and this, that, and the other, and you're going, yeah, that's great. But let's say that, you're a buy the 20-day low counter trend guy. The whole concept of counter trend is, is this, well, things revert to the mean. Well, even that very language is incorrect even in and of itself. And so we look at it and we say, look, the only way to make money for somebody who's not necessarily on Wall Street in terms of a market maker like we've talked about is whenever things move. And so immediately that puts you into the bucket of, it doesn't matter if you're fundamental or you're technical or whatever it is, your job is to then create that positive kurtosis view. And we actually have we've done testing on this, and we have a system that applies trend following to stocks that have been ranked fundamentally. And that's, so what are you trying to do? It's this concept of, okay, we'll filter your universe. What's good and what's bad fundamentally? If the client likes it, we get it, we understand it. And yes, we've been able to see that over the course of 100 years, if somebody's still in an index, it's because they most likely manage their assets and their cash flow properly. Really, really basic stuff that you can actually go back in time, not these crazy ratios and all this other stuff. So then you say, all right, everything on top of that, after that point, is managing things from a trend following approach, aka, when price moves. It's the only way that you can make money. It's the only way that these fundamental guys can make money. They say that they all hate volatility, but volatility is the only way that they can buy at 10 and sell at 100. And so those four concepts really, we love talking about those four concepts because it really gets us on a level with a client to really make sure that they understand where we're coming from and how we believe that markets actually fundamentally operate as well. We believe that's an important component of market structure dictates how one should be investing.
I think on part two, we can know from the beginning we're going to go in two different areas. I'm going to force more of the mutual fund conversation, perhaps until maybe you break and say, I really need to get behind the scenes and know what you saw. You might eventually just say, Uncle, I can't go there, Mike, sorry. And then I'd like to also, I've got a ton of notes here where I'd like to break down a lot more of your trend following expertise and let you educate the audience. But hey, where is the best place we can send people for right now to check you and your firm out?
Yeah, absolutely. We have our website, www.hawkingalpha.com. and that's really kind of the best place to go to when, and you can contact us and literally I reply to it. I like to be hands-on with people. One of the things that I learned from both my mother and my father, they were missionaries, just being that teaching aspect. If I can, even if somebody never invests with us, and I say this to clients all the time, look, if you don't go with us, let me give you other big name guys that I would put my money with, that I believe in. So if anybody ever has a question, I literally answer and reply to everything.
You make a good point about the emails, and you made it earlier about reaching out to guys, big name guys that responded to you. I mean, I had a lot of those similar experiences, and I feel very strongly also about email response. I respond to everybody, and I have for over 15 years. I think if I didn't do that, I probably wouldn't be talking to you. I think there's something to be said that if you're starting from scratch and you want to connect with people, you got to interact. And if so I'm with you 100%.
Absolutely. And I think even for the guys that have made it, we now live in a day and age where even a Paul Tudor Jones has to, needs to reach out and needs to be interacting with people. Now he does it through a TED Talk and, through conferences and stuff like that, but that's people's way of getting access to a guy who, you gotta be out there. You gotta be in front. This is one thing that we could probably pick up in the second talk. I really kind of feel, after all the people that I've met, that, the generation of true trend followers is actually starting to kind of die out. There's very few of us that are actually left. Now, there are these large firms, but it's interesting how many of these large firms I've actually gone to where the underlings don't really know, or if you ask them a really poignant question, they don't necessarily ascribe to even what their boss is doing. It's very interesting to me because I almost see it as, hey, did a negative interest rate policy create almost a dying art now? And I can be completely wrong with that. I believe in this day and age of information, there's tons of people that are learning about it. But whether or not they're applying it properly and going down the right road, I think that the process itself is...
Trust the central bank authorities. They have got this negative interest rate thing taken care of. The stock market can only go up. The idea of Nassim Taleb's Black Swan is dead. It will never happen. Mark Spitznagel is wrong. There is no chance for anything to ever go down. Just trust the system, put on your tight underwear, and just sit back and enjoy the ride because nothing can possibly go wrong. Right, Josh?
Yeah, and that is I tell you what, it scares, even I had this conversation with a client the other day because they were astounded that we actually could short stocks. Literally astounded. And I said, well, why wouldn't you? And they said, why would you? And we had this interesting talk. And I said, well, here's the one interesting thing to think about. If you go back way in time, before the Fed and all that kind of jazz, there used to be what's called a risk premium in stock. Read Benjamin Graham. There's even whenever these fundamental guys look at, the return of a stock, they look at what's called the risk premium. And so I tell people, if you think that the long-term growth of the stock market is really going to be that good in a zero to negative interest rate policy, all you're really doing is taking up the risk premium of stock, which means that, and this is one of the tenets that we talk about, one of the 5 tenets, the only way that return can occur is if there's real risk. That's a real danger that in a talk that I have with fundamental guys, where I tell them, look, you can't tell me that the more that the Fed artificially takes out risk premium, that it means that stocks are going to go up, and never go down. And in fact, you begin to almost get this Taleb moment of... Don't you blaspheme.
What are you doing not trusting the Fed? Come on now.
I know. It's a problem that I have. I always kind of have this issue of bucking, I'll even buck myself.
I'm not a big movie guy, but I did really enjoy, I didn't read the book, but I enjoyed The Big Short. There's going to be... The Big Short got all the credit for that time period, and Michael Burry, just developing this strategy that got him short one time. But what's really interesting is trend followers have been doing the same damn thing and got that same trade structure on during that same time period as Burry. But trend followers have been doing this thing for decades.
Yeah, and that's not sexy. You can't make a movie off of, somebody like David Harding who does a CNBC interview and I'm literally crying, laughing at how much they just literally don't get it. And you got him who's sitting there, this genius of a man literally looking at the producer going, are you guys really doing this? Is this really how you guys operate?
I think he was shell shocked in every one of them. And I kept thinking, I kept trying to get in his mind thinking, you know what? He probably thinks it's going to get better each time and it would get worse.
Yeah. I mean, you look at it and it is, you feel bad for the guy because, somebody could learn so much from the 5 sentences that he said. And yet most people got out of that. Wait a minute, this guy doesn't predict stuff. And so why would I ever get with him? Because prediction's sexy. Prediction is the cocktail party story and everything else. And
if CNBC's audience bought into the idea that what David Harding was saying was important, then the next logical conclusion is, why the blank am I watching CNBC?
That's right. So, it's Wall Street in and of itself is a very interesting self-serving game. And that goes back to the very first question we always ask people: what is the purpose of the market? If it's to facilitate the team's transfer of risk between two parties, then man, everything else outside of that and around that is really just to facilitate that. So yeah, you got to ask yourself, why do I deserve to get paid? And that's a question that we ask ourselves all the time, and we deconstruct our systems constantly just to make sure. And it's not that we don't have trust. It's just saying, hey, you learn the lessons from, Harding talks about this. The first book that everybody has to read at their firm is, When Geniuses Failed. Doing that same thing, or just constantly questioning yourself, that higher level, that what they call second level of thinking. Question yourself. Ask yourself, am I wrong? Why am I wrong? And go down the road. So yeah, but you don't want to question yourself whenever you're on TV, and that's why you get the Dow's going down, and I'm going to stick with it and never change my position.
I need just one CNBC interview is all I ask for, because I won't be invited back, but I just want one, I mean, it would just be a complete joy. I mean, they'll say, okay, Mike, you're banned. Okay,
yeah, exactly.
Josh, we will try and get part 2 in by the time the year is over. I appreciate you taking some time today.
Absolutely. Yeah. Thanks for having me on, and hopefully there's been some nuggets in there that people are able to absolutely run with. And then, like you said, anybody that ever has a question, don't ever hesitate to reach out. We have kind of a unique background, history, and exposure, and we're the guys that have tested everything under the sun.
Josh, I appreciate it. Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.